it's a chart that you shared on Twitter recently, showing that intangible assets make up 90+% of the value of the assets in the S&P 500. So, that's things like patents and goodwill and all sorts of things like that. It's a mind-bogglingly high percentage, and it makes me ask the question: how much of the current market value of the S&P is perhaps like phantom value, like value that really can't be, justified by fundamentals, and we're all just kind of crossing our fingers and just wishing that yes, these intangibles are worth what they're saying they're worth?
Well, yes. I mean, price to book value is one way to value the equity market, and a lot of growth investors have said this is this is an outdated way to look at markets. Ben Graham, were he still alive, would beg to differ that tangible assets are really the only thing you have to hang on to in times of distress. But people don't even think about times of distress, right? Financial crisis is a distant memory. So in most people's minds, if they even were old enough to know what it was when we went through it. But I think the biggest issue for me is that people are looking to forward price to earnings ratios, even trailing price to earnings ratios, without understanding that profit margins are at their highest levels in history. And profit margins are one of these things that are very cyclical, and Jeremy Grantham's called them the most mean reverting series in finance. So if you're using a price to earnings ratio, and those earnings are inflated, by the highest value margins in history, you're making an assumption that profit margins are going to stay elevated indefinitely into the future. That's an embedded assumption when you're using a price to earnings metric. And so I think that's something that just people don't even consider, don't even appreciate. Well, what if profit margins mean revert back to just a normal historical level? Well, that means we're not at 16 times earnings. It means we're 30, 40 times earnings right now, right? When you normalize for profit margins. And so that's why I say, when you look at, any type of long-term valuable measure of valuations, we're at the highest, we're still above all the previous peaks in stock market history. So you can talk about what would make for a mean reversion in corporate profits. I think the biggest thing for investors to consider is that wealth inequality has gotten to a point where we're starting to see political problems. Warren Buffett wrote about this in his famous 1999 and 2001 articles in Fortune magazine, where he talked about the dot-com bubble. And he said, when corporate profits, you really can't expect corporate profits to be above 6% of GDP for any prolonged period of time, because you'll get political problems. If corporations are taking a bigger slice of the pie than labor for too long of a period of time, you get political problems. And so I think that's what we're seeing today with corporate profits have been so elevated for so long, and that's one of the things that's been driving wealth inequality, where labor has been taking a much smaller share for so long. That we're starting to see a reversal in this dynamic. And this comes back to globalization and all these things, right? What enabled corporate profits to do what they did was offshoring of labor, right? That enabled corporate profits to be so elevated because they lowered their cost of doing business. So deglobalization is also the probably will make for a peak, a long-term peak in corporate profit margins. That we'll look back and say, wow, 2022, 2021, those profit margins were literally off the chart. And we're starting to see, political movements towards that are starting to address things like wealth inequality. And what that means is addressing corporate profits. I think we're probably going to see a raise in the corporate income tax. And we're seeing a 15%, Democrats are really pushing for a 15% minimum tax. That's probably just a start, because what you understand when you look at history is wealth inequality does this for long periods of time, where it widens and the wealthy take a greater pie. And then you either get a redistribution through, the democratic process, or you get revolution,
or the pitchforks come out. Yeah,
exactly. And so we're at that point where you're going to get redistribution, or you're going to get revolution. And that's, you can read The Fourth Turning, by Neil Howe, and a lot of people have talked about it in different ways, but I think that's where we're at, and it puts a big red target on financial assets in general.
If you enjoyed this video clip, click here to watch another one you should like.